Ever wondered why low expense ratios are crucial when choosing an ETF? Let's delve into this often overlooked but essential aspect of ETF investing. Firstly, let's define what an expense ratio is. In simple terms, it's the total percentage of fund assets used for administrative, management, advertising, and all other expenses. It's essentially the cost you pay to have someone manage the ETF for you. Now, why is a low expense ratio important? Well, it's all about maximizing your returns. Consider this. If you invest in an ETF with a 1% expense ratio and that ETF returns 8% annually, your net returns are really 7%. That 1% might not seem like much, but over time it can significantly eat into your profits. Let's illustrate with an example. Imagine you have two ETFs, ETF A with an expense ratio of 1% and ETF B with an expense ratio of 0.1%. If both ETFs provide the same gross return, say 8% annually, the investor in ETF A will receive 7% net returns, whereas the investor in ETF B will receive 7.9%. Over a span of 20 years, if you invested $10,000 in both ETFs, the difference in final returns would be quite noticeable. The lower expense ratio of ETF B would result in more money in your pocket. So you see, even a small difference in expense ratios can have a significant impact on your long-term returns. It's like a silent drain on your investment that can cost you thousands over the years. Therefore, when choosing an ETF, it's crucial to consider the expense ratio. Of course, it shouldn't be the only factor you consider. The ETF's investment strategy, its holdings, and its suitability to your investment goals are all important. But, all things being equal, a lower expense ratio is always better. Now, understanding the significance of low expense ratios, let's delve into some ETFs renowned for their low expense ratios. First on our list is the VOO, Vanguard S&P 500 ETF. When it comes to a low-cost way to gain exposure to the broad U.S. stock market, the Vanguard S&P 500 ETF, also known as VO, is a standout choice. This ETF is designed to track the S&P 500 index, which includes 500 of the largest U.S. companies. This means that when you invest in VOO, you're essentially investing in a piece of these 500 companies. One key feature of VOO is its low expense ratio. An expense ratio is essentially the cost of owning an ETF, and with VO, this cost is incredibly low. In fact, it's one of the lowest you'll find in the ETF market. This means more of your money goes towards your investment, rather than being eaten up by fees. VOO's long-term performance is another highlight. It has consistently shown strong returns over the years. While past performance is never a guarantee of future results, VOO's track record does provide some reassurance for investors. VO is also a great way for investors to gain broad market exposure. Because it tracks the S&P 500, it offers a diverse range of investments, from technology to healthcare, finance to consumer goods. This diversification can help to spread risk and potentially smooth out some of the ups and downs of the market. VOO is a solid choice for those seeking a low-cost, broad market exposure. Next, we have the SCHB Schwab US Broad Market ETF. The SCHB is a remarkable product from Charles Schwab, one of the most reputable firms in the financial industry. It's a broad market ETF, meaning it seeks to capture the performance of an extensive portion of the U.S. stock market. But what makes SCHB stand out in the crowd? Well, it's the incredibly low expense ratio. You see, the expense ratio is the annual fee that all funds or ETFs charge their shareholders. It represents the percentage of the fund's assets that go towards running the fund each year. And in the case of SCHB, this ratio is very, very low. This means that more of your investment stays in your pocket, which is always a good thing, isn't it? The SCHB aims to track the Dow Jones U.S. Broad Stock Market Index. This is a significant index that covers a vast array of U.S. equities, from large cap to small cap companies. So, with SCHB, you're getting exposure to a diverse range of sectors and company sizes, which can help to manage risk and provide potential for growth. But it's not just about diversity, it's about cost-effective diversity. The low expense ratio of SCHB makes it a highly efficient vehicle for investors seeking broad market exposure. It's like having a slice of the entire U.S. stock market, but without the hefty price tag. SCHB offers a cost-effective way to gain diversified exposure to the U.S. equity market. Another excellent low-cost option is the ITOT iShares Core S&P Total U.S. Stock Market ETF. With an impressively low expense ratio, ITOT is a standout product in the world of exchange-traded funds. It's a fantastic choice for those who are looking for a cost-effective method to gain broad exposure to the U.S. stock market. The ITOT aims to track the performance of the S&P Total Market Index, which is a comprehensive, broad-based index that includes all U.S. equities. This means when you invest in ITOT, you're investing in a tiny slice of the entire U.S. stock market. From the heavyweights of the industry to the small startups, you're getting a piece of it all. Having a low expense ratio is a huge advantage for any ETF. With ITOT, you're not only getting access to a wide range of stocks, but you're doing so at a fraction of the cost. This means more of your money goes towards your investments rather than fees, which can really add up over time. ITOT's low expense ratio, coupled with its wide exposure to the U.S. stock market, makes it a great choice for beginner traders and seasoned investors alike. It's a simple yet effective way to diversify your portfolio and potentially increase your returns over the long term. ITOT is a cost-effective choice for those seeking comprehensive exposure to the U.S. stock market. Lastly, we have the VTI Vanguard Total Stock Market ETF. The Vanguard Total Stock Market ETF, fondly known as VTI, is a key player in the ETF universe. The VTI boasts a low expense ratio, a feature that has become synonymous with Vanguard's offerings. With an expense ratio as low as 5 basis points or 0.05%, it's a cost-effective choice for investors who want to keep more of their investment earnings to themselves. This ETF aims to closely track the performance of the CRSP US Total Market Index. For the uninitiated, the CRSP US Total Market Index is a benchmark that represents nearly 100% of the US investable equity market. That's a vast range of small, medium, and large cap stocks from across the United States. This broad exposure makes VTI an attractive option for those wanting to dip their toes into the vast ocean of U.S. equities. The VTI doesn't just offer broad exposure. It's also about long-term performance. Since its inception in the early 2000s, the VTI has consistently delivered robust returns. It's a testament to the power of a buy-and-hold strategy, offering a low-cost, efficient way to gain diversified exposure to the U.S. equity market. The VTI is a great choice for investors who want to build a core portfolio or for those who simply want to take a set-it-and-forget-it approach to investing. It's a low-maintenance, high-reward investment tool that could serve as the bedrock of any portfolio. This ETF isn't just about numbers and percentages, though. It's about the opportunity to participate in the U.S. economy's growth story, to be part of something bigger. It's about the chance to invest in a wide array of companies, from blue-chip giants to promising startups, all with a single investment. In conclusion, the VTI stands as a testament to Vanguard's commitment to low-cost, wide-ranging, and long-term investing. It's a holistic approach to investing that has stood the test of time and continues to deliver. VTI is a great low-cost ETF for those wanting comprehensive exposure to the U.S. stock market. Now that we've examined several ETFs with low expense ratios, it's time to recap. It's essential to grasp the importance of low expense ratios in exchange-traded funds. Expense ratios, the annual fee you pay as a percentage of your investment, can significantly impact your returns over time. They're like a silent drain on your investment's growth potential. The lower the expense ratio, the better for your long-term financial health. We delved into 4 ETFs that offer strikingly low expense ratios. The Vanguard S&P 500 ETF, known as VOO, tracks the performance of the S&P 500 and offers a low-cost way to gain exposure to this market index. Then we discussed the Schwab US Broad Market ETF, or SCHB, which provides a broad, diversified exposure to the US stock market at a very low cost. Next up, we explored the iShares Core S&P Total US Stock Market ETF, or ITOT. This ETF covers the entire U.S. equity market, and again, it's all about low expenses. Lastly, we looked at the Vanguard Total Stock Market ETF, or VTI. It offers a way to own the whole U.S. stock market in one fund, with a low expense ratio, of course. In conclusion, expense ratios are a crucial factor to consider when making investment decisions. They may seem small, but over a long period, they can have a substantial effect on your returns. Remember, a low expense ratio can significantly affect your returns over time, so choose wisely. Let's now shift our focus to another exciting segment of the market: growth stocks. These are shares in companies that are expected to grow at an above-average rate compared to other companies in the market. They're attractive to investors as they often yield high returns, although they can also pose higher risks. Here are some growth ETFs you might want to consider. The Vanguard Growth ETF, or VUG, is one option. This fund focuses on large-cap growth stocks in the US. Then we have the Vanguard Mega-Cap Growth ETF, MGK. This ETF targets the largest growth stocks in the US market. The Schwab US Large Cap Growth ETF, SCHB, is another option. This fund offers exposure to the largest US growth stocks. The Invesco QQQ ETF, QQQ, tracks the NASDAQ 100 index, which includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market. The iShares Russell Top 200 Growth ETF, IWY, focuses on large-cap growth stocks. Lastly, there's the Vanguard Russell 1000 Growth ETF, VONG, which targets large and mid-cap growth stocks in the US. These ETFs have shown significant growth over the years, and they could be a great addition to your portfolio, especially if you're seeking higher returns and are comfortable with a higher level of risk. However, it's crucial to remember that while growth stocks can offer significant gains, they can also be more volatile and risky. Always consider your risk tolerance and investment goals before diving in. Investing in growth stocks can be a great way to increase your wealth over time. But as with any investment, it's important to do your research and understand what you're investing in. Remember, every investment comes with its own set of risks and rewards. Next time, we'll delve deeper into the world of growth stocks and discuss how to analyze and select them. Stay tuned. Now let's discuss investing in dividend stocks in the IRA to avoid tax. Dividend stocks are shares in companies that pay out a portion of their earnings to shareholders in the form of dividends. These can provide a steady income stream, which can be especially beneficial for those in retirement. As we venture into the world of dividend stocks, here are some you might want to consider for your IRA. The Vanguard High Dividend Yield ETF, or VWEM, is a popular choice. It focuses on companies that pay a high dividend yield. Then we have the Vanguard Dividend Appreciation ETF, VG, which targets companies that have a record of increasing their dividends over time. The Vanguard Real Estate ETF, VNQ, focuses on real estate investment trusts, which are known for their high dividend yields. The Vanguard International High Dividend Yield ETF, VDU, provides exposure to high-yielding companies outside the US. Lastly, there's the Vanguard Utilities ETF, VPU, which targets utility companies, a sector known for its high dividends. These stocks not only provide a steady income, but also have tax advantages when held in an IRA. The dividends these stocks pay are not subject to tax until you withdraw them in retirement. This allows your investment to grow tax-deferred, maximizing your return potential. Investing in dividend stocks in your IRA can be a smart move to maximize your returns and minimize your tax liability. However, as with any investment, it's important to do your research and understand what you're investing in. Remember, every investment comes with its own set of risks and rewards. Next, we'll dive deeper into the world of dividend stocks and discuss how to analyze and select them. Stay tuned.